Bond yields have spiked over the past week, but have they gone too far too fast? Mike Santoli taking a look at whether there's a bond buying opportunity right now with the aforementioned mystery chart.
Yes, exactly. So it's stocks versus bonds. Let me explain more specifically what this is. It's the S&P 500 over the last 2 years against the Barclays Aggregate Index ETF. So this is a total bond market index. And you see stocks have outperformed bonds by 40 percentage points in the last 2 years. This begins 2 years ago. What you've seen, though, when you've had an acceleration in stock versus bond performance, this was the run up into January. You had a quick gut check there. This is not as dramatic, but it's still relatively steep. And when I say perhaps a buying opportunity for bonds, it's not a prediction that, in fact, yields are going to start collapsing again, but it is something that would basically affect somebody who had a balanced portfolio. If you started right here with 60% bonds, stocks, 40% bonds, you're now at 68% stocks and 32% bonds. So your natural rebalancing would be selling some stocks to buy some bonds here. The final point is, because bond values have been going down as stock values have been going up, it shows you that stocks can go up while rates go up. At this point, the 10-year Treasury was at 1.7. It's now at 3.2, almost doubled, and stocks in absolute terms are up more than 30%.
Traditional sort of portfolio strategy of balancing between the two asset classes, of course, is based on the assumption that if one, over a long period of time, is going up, the other is going to go in the opposite direction. Is it possible that we're heading for a moment where that's not going to be the case, particularly in the case of a big pullback for equities? Could we also see bonds move in the same direction?
You could, and there's been a little bit of a hint of that because stocks and bonds have become inversely correlated in that way, or more correlated in that way. I don't know that you're necessarily going to see. That would imply kind of a stagflation story where rates go up a lot and stocks collapse. So yes, absolutely, but I still think bonds would go down less than stocks in a stock bear market, obviously.
What would be your protection in that environment? Gold or something?
Cash. I mean, I think gold. Right now that's the alternative, is because cash is actually paying you something right now. And, 1 month treasuries are 2% or something like that.
It sort of gets at the question which we've been asking on the network all day, which is, well, if bond yields are going up for the right reason, and that is better economic growth, lowest unemployment rate in decades, can the stock market march higher as well and break that traditional relationship? What does history say about that?
History says, yes, that can happen. Stocks can continue to benefit from the good environment, but I think the sensitivity to it is, as we've been saying, how fast yields go up and also how much the economy and profit growth decelerates next year. Because if you're in a situation where money costs more, you have a little bit less liquidity, financial conditions are tighter, companies paying more for debt, at the same time cash flows are going down and the Fed staying aggressive, that could give the stock market a little bit of trouble.
It's sort of like with the dollar and stocks. They can go up together if things are all working out in the U.S., but if it starts going up very fast, where it's really detrimental to profits, then it's a problem for stocks.
Yeah, it upends some part of the capital markets.